Good afternoon, everyone. Thank you for joining us for our quarterly webcast. My name is Meredith Ward. As you all know, I'm your Wealth Relations Associate. Today, our presenter is our Chief Investment Officer, Jack Brown. And Jack will be discussing our current and long-term outlook on the equity and fixed income markets. At the end of the presentation, I will open up the line for questions. You should see on your screen a dialog box in which you can type in a question. So feel free to ask as they come to you, and they will be answered at the end of the presentation. Before Jack begins our presentation, our managing partner, Jim Neal, would like to say a few words about O.D. Ward's passing. Jim?
Thank you, Meredith. O.D. and I started this firm on January 1, 2009, and we've come a long way, and it was with a great deal of sadness that O.D. passed away on August 19th. I think most of you are aware of that. We just wanted to officially recognize it on this webcast. His contribution to this firm was absolutely invaluable. We'll miss him, but we'll go forward. And as part of that, I wanted to also announce today that Jack Campbell has joined our firm. I joined it today, as a matter of fact, early this afternoon. Jack will be working in our wealth management client servicing area along with Meredith, and he brings a lot of years of experience, and he brings financial planning expertise, something that we have not had a lot of to date. I think that we look as we go into the final part of the year. Our performance this year in the markets has been very good, and now that we have a full complement of client servicing people, we feel very comfortable going forward. We probably will have another personnel addition over the next few months, and we will keep you informed as that comes. But I did want to acknowledge the passing of O.D. and how much we'll miss him. So with that, Meredith, I turn it back to you.
Okay. Thank you, Jim. To begin the presentation, I'd like to welcome to the call Jack Brown.
Thank you, Meredith, and thank you, Jim, as well. We are at all-time highs in the market, and the economy is doing rather well. So it's a lot of good news on the surface. However, of course, it's very important to hit the pause button every once in a while and take a peek under the hood. And with this call today, we're going to do that. There's some very interesting dynamics in the market, in the economy that I'd like to share with everyone listening. With that, let's jump to the first slide. This first slide is sort of a year-to-date chart that shows us how well the markets have been doing. Specifically, the S&P 500 at the creation of this chart, which was not too long ago, a few days ago, a couple weeks ago, excuse me, and it was up about 15%. Now that is a very good year so far in the markets. It's ahead of normal for sure. What makes 2017 very interesting is that this is a growth year as well. So the growth markets, the broad growth market is doing extremely well. It's up over 20% so far this year. That's a strong year. You can also look at the value markets, and we're looking at businesses that aren't necessarily growing their earnings quite as fast traditionally, but they're maybe cheap statistically. And on that basis, that market's doing okay too. I think in most years we would say, 8.5%, 9%. That's a good solid performance, but it is dramatically less than growth. So this year, growth is an important market to look at. And so we're going to zero in a little bit on that. And so with that, let's jump to the next slide, please. Okay, most people have heard of the acronym FANG. It stands for Facebook, Apple, Amazon, Netflix, and Google. And those are the largest, most dominant, fast-growing businesses out there in the stock market. So what's been interesting here is that group, and on an individual basis, they've all done better than the broad market, and they've all done better than the broad growth market as well. So these are very large companies collectively making up about 10% of the overall market, which is a big chunk of the market between these 5 companies. They've all done very well. So one of the questions you might say is, geez, you know, these companies have been doing great this year. They've been doing great for the past 10 years. Should we concern ourselves that maybe we're facing some kind of bubble, at least with these guys? And that's, you know, an important thing to take a quick peek in, especially because in our growth strategy, we own a few of these names. With that, let's jump to the next slide. So to answer my question, are we in some kind of bubble? The title of the chart is pretty much gives you away our feelings on the answer is that FANG valuations have not bubbled. And one of the ways we can get to that conclusion is by looking at various statistical measurements. And this one, the price to sales ratio, shows you the comparison of the price, the growth in the price versus the growth in sales. So let's track the price and the sales over time. How do those P or price to sales ratios change over time? And in this chart, we're looking at those 5 companies, and we're going back the past 10 years. And what you'll notice is that as a group, and for the most part individually, they stay within a certain channel. If we were looking at some kind of bubble, you would see the price to sales ratio go up and to the right. In this particular chart, we would see price to sales ratios go up. In other words, the stock prices are shooting up and the sales are growing, but maybe not quite as fast. That's definitely not the case. So they're kind of earning their keep, if you will, from a stock price standpoint. So that's good news. It's good news if you're a growth investor and if you're own some of these names. So that's something that's important. Now, another question is how does this look compared to the overall market? Maybe the market's getting cheaper, or maybe it's getting more expensive. We know that the FANG stocks, they're always a little high on the valuation side, but they haven't gotten they haven't bubbled. Like, we don't want to see something bubble because we're afraid it's going to pop. No bubble here, but let's take a look at the market on the next slide. Now, we don't think the stock market is bubbling, but we do acknowledge that the valuation of the market is certainly getting a bit on the expensive side. So we really want to zero in on that, get a good sense of what's going on. This is probably, in our opinion, a very important concept to keep an eye on. So with this particular chart, what we're looking at is the price to sales ratio, just like the last slide, except we're going to do it for the overall stock market. So as a group, how have the price of stocks changed relative to the sales change over time? And what we see in this case is that it does go up and to the right. And so the price to sales ratio is climbing. And from a valuation standpoint, this would be one metric that shows that the market is getting more expensive. Now, in previous presentations, we've shown other similar type charts. We like what's called the CAPE ratio, which I think a lot of people look at, but it's a cyclically adjusted way of looking at price to earnings. That sort of shows us the same thing, but price to sales is kind of doing it in another way, but it's showing us that the market's more expensive. Let's look at the next slide. Another fun way of looking at market valuation is looking at the overall size of the stock market. That would be the market capitalization. So the size of the stock market is over $20 trillion at this point, but we compare that to the size of the U.S. economy. So that's an interesting comparison. Warren Buffett has made that a little more famous. It's one of the things he historically likes to look at. But this is looking at the past 10 years, just like the price to sales on the previous chart, except we're looking at size of the market versus size of the economy. Now, over the long run, we would expect to see the economy grow at about the same rate as the stock market grows. That would be kind of normal because businesses grow as the economies grow, and of course, stock prices grow with businesses. So over the very long run, we would expect to see this line kind of be flat. But what we see instead in the past 10 years is that it's going up. So this is another chart that's showing us that the market is a bit on the expensive side, at least relative to its own history. And so that really zeroes in on the question is, what do we think about the market valuation? Is it okay? How did we get here? And what are the things we're looking at as we go forward? We zeroed in a bit more on the last presentation on how we got here. And from our view, a long and uninterrupted string of economic growth, which is what we've seen since 2009, that kind of leads to this slow build in confidence. And people, more and more people are putting more and more of their assets in the stock market just over that long uninterrupted growth period. Add that to the idea that interest rates are low. So when interest rates are low, you're an investor, you have to reach some kind of conclusion. I can put my money into bonds. I can get some, 2 to 3% in interest or coupon and put that in my pocket and move forward. Or I can get 2 to 3% dividend yield with the idea that here's a company that pays a dividend and that could increase its dividend over time. And so what we're seeing in a lot of cases is that the stock market is winning the jump ball compared to the bond market based on low interest rates. A third factor that we talked about a couple of years ago, and we thought it was very important, and we're starting to wonder if maybe we got to start looking at this again, is the idea that the Federal Reserve has been very generous to the market because it's done a lot of buying of assets. So we want to revisit that concept as well. But that historically has been good for the market in our view. So that leads us to the question is, what are we looking at going forward? So we kind of know how we got here, but looking ahead, what should we concern ourselves with? And from our perspective, it's largely the same elements that got us here. We know that the stock market, the big corrections in the stock market seem to happen almost exclusively, and I'm talking about those big corrections that last several months and over a year in some cases. Those are the corrections that are the more painful ones. Those almost exclusively happen in and around recessions. So recessions, of course, are a very important thing to concern ourselves with. So understanding the economy is certainly an important concept. And so with that, that's where we're looking at some good news from our perspective. And on that, we'll jump to the next slide. So in our view, we've had this long period of uninterrupted growth in the economy. A lot of people said, hey, it's a lot slower than it should have been in an economic recovery. Geez, isn't that terrible? Well, that may be true, but nevertheless, here we are. And so we have to ask ourselves, what's next? Is the economy going to heat up or is it going to slow down? And from our perspective, things are starting to heat up. And that's for very important but also logical reasons. So much of the economy is built around the consumer. When we're just looking at consumption, based on what consumers are spending, it's about 2/3 of the economy. But when we add in things like residential construction and things like that, it becomes a much bigger part of the economy. And the rest is government spending and businesses, and those indirectly, of course, are influenced by the consumer as well. So understanding where the consumer is, in my mind, a number one thing to look at. And on that, from that perspective, we're splitting the consumer into two realms right now in terms of how we're looking at where they are right now. And one is their ability to consume goods and services, and what is their willingness to consume goods and services. It's sort of similar to how we speak to investors in understanding risk, because every investor is different. Every investor has a different willingness to take risk and also a different ability, and those are two different things. And with the economy, it's not much different. So the ability to consume goods and services is looking good. And some of those statistics are based on improving wages, low unemployment. At this point, those statistics have become pretty clear. I think most people would unanimously agree that, yes, those things are happening. Another thing to look at is the financial strength of consumers. So we're looking at household liabilities and comparing that to disposable income or to assets, or there's a variety of different metrics where you can look at the consumer and say how strong are they, and the answer is a lot stronger than they were 10 years ago, mainly because household wealth is higher, people are making more money, and they're much more employed and things like that. So the consumer strength is looking pretty good. The banking system, you'll have maybe some different views here, but from our position, simply looking at things like bank leverage, how levered is a bank? It is a heck of a lot levered than it was 10 years ago, 15 years ago, even 20 years ago. Banks are actually in pretty solid shape. They have the ability to make loans and things like that. So the ability to consume goods and services looks pretty good from our perspective. Now, the willingness to consume, which would be the second key ingredient, if consumers are actually out there spending money, then we're going to see the economy heat up a bit. It's also improved, and we're looking at things like optimism and confidence and that sort of thing. And both small businesses and consumers are pretty optimistic. If you look at the different polls out there, the levels are consistent with a healthy growing economy. So that's good. Other things, if you look at household liability growth, how fast are people borrowing money, and also, what's the personal savings rate? When people start saving less, borrowing more, it doesn't sound good, but we're doing it from a position of strength. And when those things happen, that's very consistent with economic growth. So from that perspective, the economy looks like it's heating up. We're starting to get confirmation of that when we're seeing a lot of these GDP numbers and that sort of thing coming out. So, we believe that the economy is heating up for sure, which is good in the sense that we don't like recessions from a stock market standpoint. And so that's given us some confidence in the valuations that we're seeing in the market. Let's jump to the next slide, please. The another interesting area is this is a snapshot of history going from 2008 and 2015, and we're going to compare the S&P 500 to the Federal Reserve assets. So this is quantitative easing, and what you'll notice is that as the Federal Reserve added assets to its balance sheet, the stock market went up, and we see what looks to be a pretty tight relationship. I think there's some merit in this chart for sure. It's simply pretty logical. When you have a big, massive buyer, which is the Federal Reserve, they were spending roughly $90 to $100 billion a month, or $90 to $100 billion a month on new assets. Yes, they were buying bonds and mortgages, but that money was being pumped into the markets, and we saw a lot of spillover, positive spillover to the stock market as well. And so what's happening now is that the Federal Reserve is looking at unwinding its balance sheet. And you could think of this as reverse quantitative easing. What they're doing is they're letting things mature and roll off the balance sheet. That has the effect of money coming out of the market simply because things are maturing. They're taking that money and they're not putting it back in the market. So with that, it's something to keep an eye on. They're going to be doing that at a much more cautious rate than they were on the buildup. They're doing that into an economy that's heating up. So we feel pretty good that the way they're approaching it is responsible, and we certainly think a lot of bright people are there. We could debate that, but nevertheless, here we are. So at the end of the day, these are some of the things we are looking at that leads us in a positive frame of mind regarding the stock market. And so with that being said, I will end it there and turn it back to Meredith.
All right, thank you, Jack. We will now open the call for our question and answer session, and we would like to keep the questions to general questions on the bond and equity market, and ask if you have any specific stock questions that you contact us privately, and we'll be happy to speak with you about them. So I do have a couple of questions that were written in, so I'll start with this first one. What are your views on the interest rates, on interest rates?
Sure. And Jim, if you're on the call, I'd encourage you to speak up as well. But our view on interest rates is that, of course, we're in all-time, not all-time, but we're certainly in historically low interest rate levels. Our view is that as the economy heats up, we'll start to see things like increasing expectations for inflation and actual inflation as well. And of course, this is the sort of thing that's consistent with increased interest rates. Now, we think we're not overly concerned with interest rates going too high, simply because we think the Federal Reserve would be on top of that. So we're in the camp that rates are going to grow over time, but not dramatically.
This is Jim. I'll throw a couple of thoughts in. I decided not to say anything on interest rates today because virtually every call we've done, I made the statement that interest rates are too low and will go higher. And so I personally have grown tired of being, I don't know if I'm wrong, I've certainly been early. I know Alan Greenspan, the former Fed chair, has said the same thing. Jack is correct. We believe interest rates will go higher, though the pace at which they move higher will not be perhaps as fast as we might have, certainly I thought they would be. It seems logical, though, that if the economy does continue to expand from here, we will see some movement higher in rates. We're not at an all-time low. We were earlier this year. The 10-year moved up to the 245 level last week, backed off into the 230s today. That's too low, but the 243, 244, 245 yield on the 10-year represents something of a technical top. Should the 10-year rate penetrate that level, it probably will go a little higher. But for now, we're back into the same wait ball game, wait and see. Meredith, back to you.
Thank you, Jim. Thank you, Jack. Okay, another question written in was, given the protracted run-up in the stock market, which sectors do you believe are most vulnerable?
Well, we've had a run-up in technology, but as discussed, looking at the FANG area particularly, they've kind of been earning their way up. So in that sense, I think technology is one of those areas. There's just a lot of technological growth and expansion that's helping that particular sector. So not overly concerned about a run-up in that area. I think some of the more, to me, it's security specific. So it's not really a broad sector concept, but there's a lot of very good businesses out there that are trading at pretty high levels. And it's that sort of thing that I don't necessarily think they're vulnerable from a very strong correction, but I think it would be something more like, tepid growth or stock price appreciation over a long period of time. And to me, that basically translates into a very slow run of results for a lot of companies that would be on the larger side, but trading at unattractive levels. So I see a little bit more of that out there than anything else. In the small cap space, I do see some run up in some areas. We generally like to see the average PE ratio of the small cap stocks being less than the average PE ratio of large cap stocks, but you don't necessarily see that. But the interesting thing is the small cap area, there's just so many more names. There's a lot of very interesting opportunities there. So we're able to, focus on those names. But generally speaking, that's kind of the way I'm parsing it out.
I would agree with Jack, and particularly on the technology stocks, the FANG stocks that he covered earlier in the presentation. Those are real businesses with major product cycles going. This is unlike the dot-com bubble that existed back in the 2000-2001 period. These are real companies. They're disruptive technologies, and they will continue to grow. They may slow down in price movement from time to time, but the companies will continue to grow and I believe get larger.
Okay, thank you both. Another question we have is, how would you protect fixed income portfolios with a sustained rise in rates?
If you're looking at a fixed income portfolio, there's two broad categories of risk. There's credit risk, and that's the risk of an underlying bond, for example, would run into some kind of trouble, where it would either be downgraded from a credit rating standpoint or face some kind of situation where it's tougher for it to pay its bills. When that happens across the board, then the broad bond market can experience a pickup in credit risk, and we saw that very notably in the beginning of 2016. The oil market, the energy market led that charge, and it put a big, massive weight on the entire corporate bond market. And of course, things snapped back in a positive way after that. So that was an interesting phenomenon. Today, I think because the economy is pretty strong, companies are generally having good profit margins, and there aren't any major concerns with any particular sector. I think the credit risk is rather low right now. That leaves us with the other main risk in the bond markets and the fixed income markets, and that's interest rate risk. And interest rate risk relates to the idea that if you own a bond or a portfolio of bonds and rates go up, then the price of your bonds or bond funds could go down. And so your interest rate risk is something that would be painful if interest rates go up. And the classic sign for that is inflation going up. And so if interest rates go up a little bit, generally bonds and bond funds are, it's not a big deal. It happens all the time. The coupon payments generally outstrip the rise in rates or the implications from that. But if you get a big pickup in interest rates, then you're looking at problems and some, a period of negative returns in a bond portfolio. So the question of how would we address that sort of thing, I'll keep it on the interest rate side of the bond portfolio, that risk, and that mainly gets into a few main strategies which we would employ. One is we would want to shorten the overall interest rate sensitivity. Another word for that is duration. We would shorten that. And how would we do that? Well, you could sell things that have long duration or long maturities. And whether it's a bond fund or individual bonds, we could focus on selling some of those. And we would certainly consider doing something like that. Another approach is you could buy floating rate securities, bonds or loans or funds that are funds that are full of bonds or loans that have setups where if rates go up, their coupon payments go up, and therefore they actually do well in a rising rate environment. So we would look for floating rate instruments, maybe do a little bit there depending on their valuation. And then finally, another tool we would consider is something like, nowadays with the proliferation of exchange traded funds, there are certain funds out there that have an inverse relationship to interest rates. So if interest rates go up, they actually do well. We would probably only do a little bit of that, but that would certainly act as a strong defense mechanism against rising rates as well. So that's generally our approach to that sort of thing.
Okay, thank you, Jack. We have a few more that were written in here. This one says, since the market is fully valued, what is your best recommendation for clients holding significant cash reserves that are currently sitting on the sideline?
Well, cash isn't the worst thing in the world right now. I think that's you could call that dry powder, and I don't think there's a huge problem with that. There's a tremendous amount of investor confidence out there, anecdotally, working with clients and also looking at surveys and things like that. So most people say cash. Most people have this feeling right now that cash is trash. The best answer always gets down to the individual and understanding who they are and what's the best long-term setup for a client, that so-called strategic asset allocation. Because I think today the strategic asset allocation is so important, mainly because valuations are up. So I think today is a good time to reconsider a strategic asset allocation and say, you know what, this cash is a good thing, and it makes sense maybe to put it a little more into fixed income, or maybe for some reason you could possibly be underallocated to equities and it might make sense to go in there. So there's really a flexible way of looking at it, but from a purely market related answer, I would say a little bit of cash is perfectly fine right now.
Okay. Another question we have is, anything interesting in the structured note arena?
We have historically invested in structured notes, and there have been periods where the terms of the notes are much better than other periods, and that a structured note is kind of an interesting vehicle that not all of our clients have, but it provides a way of providing a bit of upside in the situation where what's called the yield curve would steepen, and so they're an interesting vehicle. Right now, the terms seem to be pretty well, and by that, the issuers of structured notes are a little more generous than usual. So I think for that, those situations where a structured note makes sense, they're interesting right now. I wouldn't say we're piling into them. We haven't really added to our structured note investments in quite a while, but there are some interesting terms out there, just because they're not doing things like adding. They're improving the terms in the sense that if the yield curve steepens, you could make a bit more money than you could, say, a year or two ago at those offerings. That's a buyer beware answer, though, because it really takes, I think, a good professional set of eyes to help understand those vehicles. Go ahead, Meredith.
Okay. And one last question, and then we'll leave it for now. How does enhanced income do in a rising interest rate environment?
Well, enhanced income, the way we've set it up is to be a very diversified strategy, in the sense that it's balanced. So we'll always have a pretty good exposure to the stock market, and rising interest rates, from a pure standpoint, the at-risk vehicle would be something like a zero coupon treasury bond, or even just a plain old treasury bond. Those are going to be very sensitive to rising rates. When you start getting further away from that, like a corporate bond, they'd be a little less sensitive to interest rates. And you go a step further away from that, and you look at the stock market. Stock market's going to be even less sensitive to interest rates. So from that perspective, a broad asset allocation strategy like we use in the enhanced income, where we have fixed income, we have a lot of corporate exposure, and then we have the equity exposure through the equity funds. I would say there's sort of a natural defense mechanism in there. That being said, because it is an income strategy, you're just by default, you're going to have interest rate risk built into it. So we think we're set up pretty well. We would employ some of those defense strategies from 2 questions ago about what would we do if rates did rise. And so, that's kind of that's how we're approaching it.
Okay. Well, I think we'll leave it there for now. Thank you all for joining us today, and thank you, Jack, for the presentation. If you wish to revisit our broadcast, I will be emailing the replay link to everyone, and it will also be available on our website within 24 hours. As always, we welcome your calls and are here to help should there be anything that you need. Thank you all again for joining and for your continued confidence. Have a great day.